Philip Hammond will be in a tight spot when he presents his first autumn budget on Wednesday, November the 22nd. The UK Chancellor is facing calls to set Brexit aside and initiate a step-change improvement in digital and physical infrastructure. Measures to encourage investment, reskill and rebalance the economy, and simplify the tax structure are also sought.
The government's under pressure. It's doing the time-honoured political gambit of trying to steal the opposition's clothes, so it's moving towards the left, it's moving to bigger spending, it's trying to buy votes with taxpayers' money at a time when we haven't really put the last wave of borrowing behind us, and at a time when the country is economically vulnerable. So they're going to get an expansionary budget. Whether that's the thing that the country absolutely needs now is a very different question.
The problem is, any acceleration in fiscal consolidation would probably weaken the economy further and make the Conservatives' chances of winning the next election even lower than they already are, whereas any loosening of the budget to try and stimulate economic growth would de facto be an admission from the Conservatives that the Labour policy of spending more is the right one.
Much has, though, already been promised. Mr. Hammond also wants to avoid another banana skin, as we saw in March. That's when he had to reverse his plans to raise more national insurance from the self-employed. That takes a mere sliver out of the forecast budget cash cake. Half of it, however, may go thanks to a downward revision by the Office for Budget Responsibility of already poor productivity growth. The lifting of the public sector pay cap will remove another quarter. And there's a cost of shoring up the NHS. Then there's the cost of the confidence and supply agreement with the DUP, promises on affordable homes, help to buy and tax allowances. These slices leave little of the cake and may wipe out Mr. Hammond's own 2% budget deficit rule. Rising interest rates will also have an impact, but that tightening is slow and a window remains ajar for cheap borrowing.
I think it is probably a risk worth taking, particularly if you're a government facing a period of economic uncertainty. What should you be doing? Stockpiling cash, if you can, to help the economy through such times as are facing us. We know that interest rates aren't going to be the solution to stimulate the economy, so the government could be looking to borrow cheaply in the market, the cheapest it's ever been, really, to make sure that it's got a little bit of dry powder for the future.
If Mr. Hammond finds some cash, will he tackle the country's infrastructure and skills issues, or the problems in the housing sector?
75% of all debt is mortgages. Every 4% change in house prices in the UK has a 1% impact on consumption. A nationwide fall in house prices unequivocally leads to a recession in the UK. The slowdown in the housing market since the Brexit vote is the major risk to the economic outlook, and the Conservatives will seek to avoid it. So just as normal, if there's a sector which could do well from the budget, I would put housing at the top of that list.
If the government can get these kind of technological incentives to improve manufacturing lines, improve the way that companies do reporting, improve almost everything about the rest of the industrial sector, that is a real opportunity for tech startups. I think you'll probably see some more giveaways for those kind of companies, those entrepreneurial ones who are based in places like Silicon Roundabout. Those kind of businesses are the ones I think the government is going to be looking to encourage.
Mr. Hammond's first autumn budget is a very tough balancing act, politically and economically. He is by nature cautious, so a transformative event is not expected.